Now consider the example of a supernormal growth. In this case, there are initially a very fast growth, which is not sustainable. So, for example, in case of chain reaction company, this is the name of a company. There is some phenomenal growth rate in the start, say 30% per year. And if we believe that this growth will remain there for 3 years, and then eventually it will drop in the fourth year to 10% and remain perpetually there forever. And if the dividends, current dividends, which are just paid, is 5 million for the whole, like all the shares, then if we want to find the value of the firm, we can find the value of the firm with the given data if we have the required rate as well. So if the required rate is 20%, we can move ahead and find the value of the firm. So in the first year, let's suppose the first year is 1 year from here onwards, and if the dividend is just paid $5 million, then after 1 year, with the growth rate of 30%, the 5 million dividend will turn into 6.5 million. So we simply, you can multiply 5 million, the current dividend, with the 1.3. This 1.3 is suggesting there is a 30% growth rate. So we'll get 6.5 million by the end of the first year. By the end of the second year, now there is another 30% growth rate. So 6.5, the previous, the dividend which we will be receiving at the end of the first year, now will be multiplied with 1.3, suggesting a 30% growth rate in the second year as well. So the dividend will be paid at the end of the second year will be 8.45 million. For the third year, it is 10.985. So by the end of the third year, the dividend will be paid 10.985. So what is the price at that time? Let's suppose all the shareholders will sell the shares of their stock at the end of the third year. Then what would be the price of the firm at the end of the third year, which will be calculated here as P3. And we will find the price at P3 at the end of the third year, so that eventually we discount it back to find the current price of the stock. So in order to find the price at the end of the third year, we need the dividend at the end of the fourth year. Remember, the assumption was this, that after 3 years, there will be a perpetual growth rate of 10%. So the 10% then won't change. So right after third year, in the fourth year, the growth rate will go down from 30% to 10% and will remain there forever. So we know which formula we have to use over there. That is actually the generic formula is the price is equal to the next year dividend D1 whole divided by the required rate of return minus the growth rate. So if you see, we have at the end of the third year, we have the dividend 3, which was 10.98 multiplied by 1 plus growth rate, which the perpetual growth rate will be 10%, divided by the discount rate. And discount rate from the previous slide, we know the required rate of return on the chain reaction, it seems like a very risky company, is 20% demanded by the new investors. So 20% minus the perpetual growth rate, 10%. So this will give us the price at the end of the third year, 120 million, 120.835 million. Remember, these numbers are in millions. We are just not representing the last 6 zeros. Now we have the equation set up to find the current price of the chain reaction. So the first, the dividend which we will receive at the end of the first year was 6.5 million. We have to discount it back and find its current value. The current value of 6.5 million, which we will receive at the end of the first year as an investors, uh, we can get after dividing it by 1 plus the discount raised to the power 1. The raised to the power 1 means over here 1 is not written, but automatically we know it's basically getting raised to the power. It is getting raised by the power 1. So this is how we'll find the present value of the uh, of the uh, the first year dividend. And the present of value of the first year dividend, which is 6.5 million, discounted at 20% rate, will be 5.42 million. Likewise, for the dividend 2, we will try to find the present value of the second dividend by dividing it with the discount rate and taking its power to 2, and this will give us the present value. So the worth of today, like the current or today's worth of 8.45 million discounted at 20%, will be 5.87 million. Remember, this 8.45 we'll be getting after 2 years. Likewise, the present worth of the third year's dividend and the price of the stock at the end of the third year will be discounted 3 periods back to find the current value. And once we'll find the current value, we add them all together. The total or the firm's value will be 87.58 million. And if say their outstanding shares are 20 million, we simply divide 87.58 million by 20 million, and the price per share will turn out to be $4.38. Sorry. Now, this doesn't seem practical that the dividend first grow by 30% and right for the first 3 years, and then in the fourth year there is an abrupt shrinkage, and it will jump down to 30% to 10%. So normally it won't happen. In that case, sometimes uh, we try to find a more appropriate way in order to estimate about the dividends. So one of the way is the H model. The H model assumes that there will be a linear growth decline. So it won't happen like that for 3 years there will be a 30% increase, and then right in the fourth year there is a sudden decrease uh, to the level of 10%. So it won't decrease by 20% right away. So with the linear growth, if in the first year it's a 30% growth rate, then by the fourth year, if it is 10%, then there is a linear decline. So what is the difference between the first year's 30% and the fourth year's 10%? The difference is 20%. 30% minus the 10%, we'll get 20%, right? And over 3 year period, it will change. So we simply divide the 30 at the difference of the 30 and 10%, which is 20%, by 3. So if we'll divide it, we'll see that the growth should fall by 6.67% per year in order to come from 30% in the first year to 10% in fourth year. So in the first year, the growth is 30%. In the second year, it will decline by 6.67% to 23.33%. And then further from this 23.33%, in the third year, if we subtract 6.67%, we'll arrive at 16.66%. And in the fourth year, then same 6.67 if we'll subtract will come to actually 9.99%, but which is almost equal to 10%. So 10%. So there will be a linear decline in the growth of the dividend. This is what each model suggests. So if we use this model, what would be the firm value? So now pause the video over here, do your calculation, and see what is your answer. Remember, in the first year now it's 30%. In the second year, the growth rate is 23.33%. In the third year, 16.66%. And in the fourth year and perpetually onward, the growth will be 10%. So if you have already paused and calculated, you will find that your present value this time will be 75.93 million, which is less than your previous calculation. And if we divide this with 20 million outstanding shares, the price of each share will be $3.80. Now, this is a lower value because in the second year and third year, in our previous case, we assume that the growth will remain 30%, but using H model, in the second year, the growth rather being 30%, it's 23.33%. And in the third year, rather 30%, again, it is actually 16.66% uh, 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 in H model. So the obviously the firm value decline just based on the H model if we'll do the calculations. Now, how to find the discount rate? We have discussed about the growth. We have also discussed other parameters, but we have not discussed about uh, the the discount rate which we'll use in our dividend discount model. So the discount rate is simply the based on CAPM, and we from your introductory classes or financial management classes, you know the capital asset pricing model is equal to it will give you the required rate of return on a risky asset, and this required rate of return on risky asset is equal to the risk-free rate of return plus the risk premium, the risk which you are taking by investing in the risky asset. You need an extra return on that, which is called risk premium. So the risk-free rate you will get by getting the US T-bills, uh, which is 30 days T-bills, and then you need to add into that the risk premium. The risk premium you will get by multiplying the stock beta. The beta of the stock in simple way is this: when the market overall moves, the stock market overall moves, what is the reaction of your particular stock or this particular stock to that movement of the market. So this is in terms of return. So if the return of the market say move by 1%, and your the the particular stock which you are considering, it just moved by 0.5%, it means that the beta is 0.5. Like it's less sensitive to the movement of the market. When the market move uh, by 1%, it is moving less than 1%, so it means it's less risky stock. So the risky stock usually move more when the market moves, so they have a beta usually more than 1, and we multiply the beta with the stock market risk premium. So the history says that the risk premium based on the data from the 1926 to 2015, if we invest in a large company stock, the risk premium on an average is 8.3%. But there is a recent survey conducted, and they suggested that the market risk premium is actually for the future will be 7%. So the median value is turned out to be 7% based on the survey from 226 financial economists. So we will use that conservative number of 7%. So you can multiply that stock market risk premium 7% with the stock beta and add that to the risk-free rate of return to come to the discount rate. This concept will be more clear with one example. So consider a Walmart. If we want to find the discount rate for the Walmart on 1st July 2020, when I'm preparing, when I'm recording these slides, then in that case, as of 1st July 2020, the rate available, risk-free rate available for the 90 days T-bills is 0.16%. So I simply went to the Treasury website, and over there I can see it's a 13-week, which is actually the 3 months T-bills, and I'm using the coupon equivalent, which is actually the 0.16%. So this is the risk-free rate of return for the purpose of calculation of the the the, the stock's discount rate. So this plus we have to multiply the market risk premium with the stock beta in order to find the risk premium of the stock. So the beta is we are getting from the Yahoo Finance site. So I simply Google the Yahoo Finance, then I put the ticker of Walmart WMT, and it took me to the summary page. And on the summary page, I can see that we have a beta over here, 0.31, which is I am using. This 0.31, anything less than 1 means that the stock is less risky. More than 1 means that stock is riskier. It's riskier than the market because the market beta is 1. So the benchmark with which we compare the beta of the stock beta is actually the market beta itself. So the market beta is 1. If the beta of the stock is less than 1, it is less risky than the market. If it is more than 1, it is more risky than the market. So when the market moves by say 1% in terms of returns, so returns move up by 1%, the return of the Walmart stock, it suggests move by only 0.31%. And if the market falls down by 1%, the return of the market of the Walmart only fall by 0.31%. So it's not like so much sensitive to the volatility of the market returns. So it means it's a less risky stock. When the stock is less risky, obviously the investors return which they want is not high, because then they are not investing in something risky. So still there is a risk premium because they are not investing in the risk-free security. They are still investing in a relatively risky security, which is the stock of Walmart in this case. But the stock seems out that stock is not that much risky. So if we do this calculation, risk-free rate of return 0.16% plus the beta of the Walmart stock multiplied with 7%, and this is actually the risk premium which we are using, and it is suggested by the survey of 226 financial economists that in future on an average 7% will be the risk premium of the stock market. So if we multiply and do the calculation, we found that the discount rate for the Walmart turns out to be 2.33%, which is very low, right? But at this time, we are also going through the pandemic, where in order to boost up the economies, mostly the central banks or mostly has decreased their discount rates as well. So this is actually the discount rate for the Walmart stock if we want to find or price the stock of the Walmart appropriately. Now we have few observations from the dividend discount model. In constant perpetual growth model, which assumes that the dividend of the stock will grow at a certain level, or say 5% forever, it is very simple to compute, because remember We do not have to deal with a lot more years, because if a company is a going concern, so we have many dividends coming out of this company. So we do not have to discount and find the present value of each of those dividends. So we have only simple term, which is P naught is equal to D1 divided by the discount rate minus the growth rate, perpetual growth rate. But this model is not usable for the firms which are not paying dividends. There are a few firms which are in their tremendous growth phase, and they want to reinvest all the net earnings back into the firm. So they want to retain the earnings rather than paying them in the form of dividends. So this is also not usable if your growth rate is more than the discount rate. If the growth rate is less than the discount rate, it can be used. It is also sensitive to the choice of growth and the discount rate. And the growth and discount rate is sometimes very difficult to estimate accurately. So it's just the assumptions which or just based on which we are actually calculating the growth and the discount rate. For example, in case of discount rate, if we change the frequency of the returns in order to calculate the beta, for example, in case of Yahoo Finance, they are calculating the beta based on the 5 years returns data, which are computed monthly. But we can also do the calculation based on weekly returns. In that case, the value of our beta will be different. So the K, which is the discount rate, is basically change, and it's subject to the way we are calculating the beta. For the growth rate, someone can use arithmetic average, someone can use geometric average. So there is no hard or fixed rule how we are calculating these things. And if we plug these different values in the same formula in order to find the price of the stock, then we can have a different values just because we have adopted some different approach to find K or G. So there can be very much unrealistic assumption of the perpetual growth rate, that there is a company which will keep growing or its dividend will keep growing perpetually at the same rate. This is a very troublesome assumption as well. It help us out in doing the computation in a simple way, but at the same time, it can turn out to be a very unrealistic assumption. Finally, we have a two-stage dividend growth model, and it is more realistic compared to the perpetual growth model, because we can assume that in first stage there is a different growth rate, and in second there can be different growth, which is more realistic. That there are some companies for example, the IT companies, initially they can grow at some high rate, and then there might be a saturation, there might be a competitors coming in, which will be driving down their returns, and obviously it will have an impact on the growth of the dividend, and the growth of the dividend can go down and perpetually remain at a lower level. So two-stage dividend growth model is more realistic compared to the perpetual dividend growth model. It is usable even if your growth is more than your discount rate in the first stage. But in the second stage, when we again start assuming that there is a perpetual growth, then your discount rate should be more than the growth rate. Again, it is not usable for the firms which are not paying the dividend, and again the value of the firm is subject to the choice of G and K, which I just discussed. It's almost impossible to find the accurate value of the growth of the dividend and the discount rate of the firm.